So that's how we will do it. Turning then to DCL, Canadian Mortgage Experts, Mr. Lloyd.
Thank you. Thank you, Mr. Chairman. Thank you, committee, and thank you, fellow witnesses. I'm a practicing mortgage broker since 1999 in the Vancouver area. I have a lending background going back to 1988. Our company serves both BC and Alberta. We have 130 mortgage brokers on our team, and we did 3,800 mortgages last year for a total of $1.36 billion. Another example is Mr. A, who separated from his wife and has been working out a separation agreement since last spring. He has planned to buy her out of the matrimonial home in the Kootenays, but no longer qualifies, and now the home must be sold. We, of course, have had a number of first-time buyers who have tried to save the down payment needed to enter the market and buy their first home. Many of those reduced their expectations of buying a house and are instead focused on townhouses and condos. With payments forced to be over 25 years, their buying power is further diminished. Our housing industry in Canada is sound. We survived the meltdown of 2007. We have had a positive impact on the economy. CMHC is a moneymaker for the government and is safer than ever. These changes were not needed and will only cause harm to the majority of Canadians. I recommend the following changes be made to the criteria for insured and non-insured mortgages, allowing 30-year amortizations, stop attempting to restrict investment in rental properties, and remove the limit on insurable mortgage size, which is currently $1 million. I welcome your questions. Thank you.
Thank you very much, Mr. Lloyd. Turning to the Mortgage Professionals Canada, Mr. Taylor.
Thank you very much indeed, Mr. Chair, and thank you very much indeed for the opportunity to present to the committee today. My name is Paul Taylor. I'm President and CEO of Mortgage Professionals Canada. We are
Thank you, Paul, please. Thank you.
I'm just going to heads down and read into the microphone. Mortgage Professionals Canada is Canada's mortgage industry association, representing 11,500 individuals and over 1,000 companies. We include mortgage brokers, mortgage lenders, mortgage insurers, and service industry providers. The mortgage broker channel we represent originates 33% of all mortgages in Canada and over 50% of mortgages for first-time home buyers, which equates to approximately $80 billion worth of economic activity annually. Canadians are also increasingly choosing mortgage brokers to obtain a mortgage. Our most recent data shows that year over year, mortgage brokers have been used 9.6% more this year than last. Not all of the traditional banks' products are available through the mortgage broker channel, though, which is an important distinction to make. And the recent changes are having a cumulative negative impact on the mortgage marketplace and ultimately on the Canadian consumer. In light of these, we're asking for some slight amendments to portfolio insurance, which I will get to shortly. As the committee is probably very well aware, as of November 30th, all mortgages submitted for inclusion in portfolio insurance are now subject to the same stress test as high-ratio insured mortgages, and many important categories have also been made ineligible. These changes disproportionately impact non-traditional bank lenders who rely upon the portfolio insurance mechanism for liquidity and ease of access to capital. And as an example of the impact of these changes, Genworth Canada estimated in October 2016 that if submitted today, approximately 1/3 of their total volume of mortgage insurance written would no longer be eligible. Banks can take loans onto their balance sheets. Smaller lenders do not have the same capital volumes to effectively compete. So as a result, all ineligible portfolio insurance mortgage products now have to be financed by the smaller lenders through other private capital mechanisms, which makes their products more costly for consumers and therefore uncompetitive. From a policy perspective, if the intent of the stress test is to protect highly leveraged buyers from themselves, then all consumers should be subject to the stress test to ensure a fair marketplace. OSFI could achieve this by amending the required underwriting guidelines. Also, setting the stress test at the Bank of Canada's current 5-year rate serves to imply that the government's intention was to favour the big banks over smaller lenders. The rate is set by the mode of the big 5 banks' posted rates, which in effect allows the banks to control the rate that creates their competitive advantage. An important contextual note: while many of the non-traditional bank lenders do not fall within OSFI's regulatory purview, it would be incorrect to suggest they are not regulated. Each province has its own regulations related to mortgage lending, and non-traditional bank lenders statistically originate mortgage loans with equivalent or slightly better default rates than the banks. For Canadian mortgage consumers, non-traditional bank lenders play an invaluable and necessary role in a competitive marketplace. There are some significant negative impacts on price of these changes. As of January 1st, the average cost for a conventional mortgage fund is increased by 25 basis points, but in real dollars, that's about $2,300 over a 5-year term. Through the full amortization period of the mortgage, it's about $10,400. In addition to these additional costs, mortgage insurers are increasing their insurance premiums on non-conventional mortgages for the 3rd time in 3 years. This is due to OSFI's newly released capital adequacy guidelines. The premiums in some loan-to-value categories are jumping by more than a whole percentage point of the value of the mortgage, and these, of course, will be costs passed on to the ultimate consumer. The stress test also creates a reduction in the purchasing power for many Canadians, which some of the other panelists here have sort of discussed. We have some regional issues as well, actually created by those. And many of these will be first-time buyers. Our chief economist, Will Dunning, tells us the stress test will mean home buyers will have their calculated gross and total debt servicing ratios increased by 5 to 7.5 percentage points, which is going to have a material impact on their purchasing power without really changing any of their specific details. The spin-off impacts of a reduction in purchasing power for the middle class could have the unintended consequence of actually creating the scenario that these policies, I think, were aimed to prevent, which is a national debt crisis caused by a significant economic decline. The new capital requirements from OSFI also require insurers to look at 2 new characteristics of a loan to determine how much capital they need to hold on hand to portfolio insure it: credit scoring and geography. We're concerned that these changes create regional price and access disparities that will disproportionately impact middle-class Canadians in areas deemed high risk. The proposal to introduce risk sharing in the market would also cause major price and access disparities. While Canada has employed historically low default rates, somewhere below 1/3 of 1%, I think we heard it was 0.28% currently on Monday, data has always demonstrated that job losses are the #1 trigger for mortgage defaults. So under a risk-sharing structure, as regional economies suffer downturns, then local mortgage costs are going to proportionately increase. And we would suggest this is the exact opposite result than the government would like to see, and oppose the social mechanism that CMHC and the securitization program is intended to create. So, in conclusion, the changes announced negatively affect the mortgage broker channel as a whole, and Canadian consumers have been more and more inclined to use the services of a broker to provide choice, advocacy, and support, and to assist in the technical requirements of mortgage qualification. Placing competitive disadvantages, then, for the non-traditional bank lenders will adversely affect this segment of the Canadian mortgage marketplace, which consumers clearly are voting for with their purchasing habits. We have 5 recommendations we would like the committee to consider to help mitigate the effects of these changes. First, suspend all regulatory measures not yet implemented. 2, adjust the November 30th change to allow for refinance mortgages to be included again in portfolio insurance. If an 80% loan-to-value ratio is unacceptable, please consider the threshold to 75% rather than removing eligibility of these products entirely. 3, that the government reconsider the increased capital reserve requirements implemented in January for insured mortgages. 4, we would recommend a review be conducted into the long-term impact of regional-based pricing on the Canadian economy as a whole, and the potential additional harmful effects on already strained regional economies. And finally, please uncouple the stress test rate from the Big 5 banks' posted rates. Use an independent mechanism to determine the rate and require its use to qualify all mortgages, not just those insured. Thank you very much indeed.
So my question is, and this is coming from the Bank of Canada's FSR report in December, looking at the increase of indebtedness levels, looking at, and I can turn to page 5 of the report. I think it's page 7. Page 5 of the report. Proportion of borrowers with high mortgage debt is increasing in many cities. And looking in the trends, isn't it prudent for any government, when CMHC is effectively backstopped by the taxpayers of Canada to implement measures designed to improve the quality of indebtedness for borrowers going forward. So I'll put that out there because I think it is prudent for any government, be it on the Liberal side or in the past on the Conservative side. So if you can take 30 seconds each to answer that, please.
I'd like to start with that. You know, I keep hearing about this income to debt ratio. For me, that is a red herring. There are two types of debt in this country. There's good debt and there's bad debt. You know, first off, who knows how that ratio is calculated? I was in a meeting with CMHC, General Manager for Atlantic Canada last week. I asked her that question. Frankly, she could not answer it. Her economist took a stab at it. We're still not sure in Atlantic Canada how that ratio is come to. But it's important to recognize there are two types of debt, good debt and bad debt. A housing payment is a good debt, as it is a debt for an asset that not only appreciates in value, but as you pay down that debt, it creates equity, which is tangible. Well, and it provides shelter, and it builds net worth, and when there is a principal balance reduction. There are multiple factors considered when granting mortgage financing: debt ratio, income to assets, debt to assets, credit repayment history, credit utilization, income stability, income source, down payment, location, property type, and other qualifying criteria, i.e. the 3% rule on revolving credit. And that is a good debt. It goes through a number of checks and balances to ensure that it is properly administered and that it is on an asset that
Sir, thank you.
appreciates.
Can we move on to the next folks? I'd like to hear each perspective.
Can we get each of the witnesses on the record in this question, because we're up to your time. Mr. Lloyd and
Sure.
Mr. Taylor.
Thank you. Of course, indebtedness is important, and we have to review what it is. But a big makeup of that ratio is not mortgage debt; it's credit card debt and car loans, and those are areas we're probably not going to get into here. But I mean, right now the requirements for our clients to get approved are strict, and then we have to go through them. We have to verify a lot of things, and unfortunately, car loans aren't the same, and credit cards aren't the same. And unfortunately, most Canadians, that's where they're running into trouble. And to me, there is good debt and bad debt, and buying a home with something that's going to, even if it doesn't go up, you're slowly going to pay down the debt. The likelihood of it going down in value is slim, whereas those other things aren't adding any assets to their bottom line.
Mr. Taylor?
Yeah, I would echo almost all of that sentiment. I think we heard from CMHC on Monday that 165% debt to income ratio, 73% of that was actually mortgage debt. The rest of it must be change, and that is tied to not great assets. If that's the case, mortgage debt is almost a forced savings plan for a good number of Canadians, and so making it more difficult for folks to start to build an asset base by virtue of their first-time purchase is really detrimental to the whole Canadian economy as a backstop. The other thing I would very quickly address, if I can, because you made mention about the Canadian backstop on mortgage through the insurance program. Our financial system is probably the best regulated in the world. We have oversight of the lenders. We have oversight also of the insurers that are insuring those lenders. And bankruptcies need to occur long before the Canadian taxpayer is really exposed to any liability there. So I think that those are very, very far-end tail issues for us to consider.
Thank you. Thank you all. Turning to Mr. Leipert.
Thank you all for being here. I'm just going to make a couple of comments and then ask, because there's 4 witnesses, everyone just to make a sort of a general response to it. I come from Calgary, and as you're well aware, the economy in Alberta has not been good for the last couple of years now, and probably getting worse. But in speaking with a home builder quite recently, all through the downturn in oil prices, they were still building and selling homes, and he said as a result of the move last fall, the new home construction in Calgary has effectively dried up. So I'd just like you to comment on that. Secondly, I would like you to comment on expand a little bit on the one-size-fits-all approach, because again, You mentioned Quebec. I'm from Alberta. It seems as though Canadians across the country are being penalized because of two hot markets, one in Vancouver and one in Toronto. And I'd like you to comment on that. And I guess the third thing is, we had a group of witnesses here the other day, and to an individual, they swore on a Bible that they had not had any contact with federal officials asking for advice on what the right approach is. I'd like you to comment whether that is applicable to each one of you. I'll leave that, all of those with you.
Mr. Taylor first.
We confirmed that Mortgage Professionals Canada was not consulted with prior to any of these specific changes being introduced.
Okay.
Regarding the question of regionality and housing starts having stalled in Calgary, from the lenders within our community, I'm hearing very similar reports of the number of applications for new mortgages this January versus last January, seeing startling drop-offs. First-time home buyers are very specifically penalized by these changes, and so by virtue of there being a real lack of new entrants onto that property ladder, there's less need for new homes to be constructed, and certainly in the regions that are economically challenged currently, you're going to see those effects first.
Mr. Lloyd.
Yeah, I echo. I wasn't. Nobody I know was asked anything about these changes, or we weren't inquired at all. As far as the regional differences, it's huge. I mean, we're trying to solve this Vancouver-Toronto situation with these changes, and it's not effective. And in fact, it's not even effective in Vancouver and Toronto. So you're bludgeoning everyone, and it's not fixing anything. And that's the problem I have with this. And I know CMHC's policy has always been not to always be national, never have a regional policy, but I think those days should change too, and I think we should have more localization for helping different situations, because we all have different situations we're living in.
Yep. Likewise, to echo the comments of our two colleagues here, we were not consulted, although we did raise these issues early November with the staff in Minister of Finance office. But to pick up very specifically on your point on the effect there, in Quebec, 40% of the buyers, either existing or new houses, are first-time home buyers. The issue here is, yes, it has an impact on housing starts, but as well it has an impact on those the resale market and the home improvement market. And it's all the chain, because those existing buyers willing to sell their house to move in either a condo or a retirement home have a house for sale, either to be purchased by another experienced homeowner or a new homeowner. So it's a chain, and all the parts are linked together. So it affects all it has impact on all the dimensions. And one of the perverse effect of this new policy there, those who are on the brink of buying a house there with just enough down payment saved there, what happened? Oh, we're not qualifying anymore, because you can have, okay, we're going to delay to purchase that house. We're going to purchase a cheaper house or locate somewhere else. We're going to call our aunt, our dad, our uncle to raise more money, or we're going to stop. No, we remain a tenant, keep that money, and now with that $10,000, $15,000, $20,000 we had saved, we're going to buy a house, a truck, a boat, something, and get some of what was called earlier a bad debt. So you end up in a situation where people will knock at the bank's door, not to borrow for a mortgage, but to get some equity or some lending for more consumption, or a trip to the south, a cruise, whatever, some are consumption-related indebtedness, which is not backed by an asset that appreciates and that you pay down as a house. So that's the perverse effect, to pick up on what Mr. Sobera was raising earlier. So thank you.
Mr. Sani.
Yeah, as far as the Canadian Mortgage Brokers Association is concerned, we were not consulted on any changes, and as I'd mentioned in my opening preamble, we'd like to be consulted. As far as regional policy, I'm going to date myself a bit here, but I was started as a mortgage broker in 1988, and there was actually a bisected policy. In those days, there was a $125,000 rule and a $175,000 rule. So if you were in an outlying area, it actually was the opposite effect. You could put a minimum down payment to a maximum of $125,000, and in a larger regional, a larger city center, you could go up to $175,000. So it has worked in the past. When some of these changes came about, our association sent a letter to the Minister of Finance's office with some recommendations, and it's in our submission. And one of the basic ideas here was, how much is enough? How much is a lot of debt? We always talk about a lot of debt. We recommended that maybe we should look at a number, and below, say, $500,000, we could actually qualify mortgages on a discounted rate, because now you have to go to the benchmark rate. And it has affected regions. We are taking issues that are maybe of concern in our primary centers like Toronto and Vancouver and putting these policies across the country, and it's not really that fair. So this idea of regional policies can work and has worked in the past.
I think any incentives at all that could assist with adding additional supply in the markets that we're seeing these increasing appreciative values in would be incredibly beneficial for everybody. I think almost all of the pricing pressure in the Toronto and Vancouver area is very specifically supply side issue. I think, to be fair, the government since 2009 has implemented a good number of changes now that tighten mortgage rules, and I would actually argue that many of them were very, very prudent at the time. I think we've got to the point, though, now where we're addressing the entire problem with demand-side solutions when supply is what really needs to be addressed. And we're creating real problems for first-time home buyers and making home ownership in Canada elitist. We really need to address supply side.
I agree. I mean, the biggest issues are the supply of homes for people to move into, and we can keep hurting the first-time buyers, but that's not going to stop this supply situation. So.
I'd like to also mention, we talk about supply, and that's important, but it appears that we do have a little bit of a issue in the municipal side of government. They control the land development side. They have the bylaws in place. They have the planning departments, and it is very onerous in my discussions with a lot of different people across the country to get a development project started. So what we see, and I'm from Vancouver in the Lower Mainland, you can see up to a 7-year delay from the time you actually identify a piece of land that you may want to develop and it actually comes on market. In that 7-year period of time, developers have to carry property. There's a lot of costs. There's soft costs, fronting development cost charges. This is a lot of money that has to be paid for up front. Their interest costs accrue, and then in the end, as I mentioned earlier, it's the home purchaser that actually pays for this. So streamlining that level of government, would it be incentives, some capital expenditures to get water treatment facilities, land dedication in place? These actually delay land development projects, and at the development side, there's costs involved acquiring land. We do those mortgages as mortgage brokers as well for these developers. Those costs accrue. So that's one way of maybe improving the supply side. You have to make it easier. It's very difficult.
Thank you. Mr. Graywall?
And thank you to the witnesses for coming. I mean, there's a lot of theories on what's going on in the Canadian housing market. I just had a few questions on data related, and I'm hoping that you guys can answer this. Can any of you guys tell me how many homes are purchased with less than 20% down payment?
I think we'd have. I don't have those numbers handy. I think that's it's something that could be looked up, but we as brokers see a lot of first-time buyers, and there's no doubt there's an inordinate level of people that are putting a minimum down payment.
The rationale for the question is this: is that the new stress test will obviously impact people buying a home with less than 20% down, and then you guys are advocating for the fact that it's going to impact your business, but you should.
No, sorry. We're less concerned about our business than we are about the Canadian consumer and the housing market itself.
Either way, even if we're concerned about that, I think that at the basics, we would need to know how many Canadians are actually purchasing homes, and you guys are in the mortgage business, so I would feel like this is one of the numbers that you would know right off the top of the head. Is like, yeah, X percentage of Canadians are buying homes with less than 20% down.
I can say that we did a sweep of our home buyers from last year, and I don't know how many are less than 20% down, but on that sweep of our home buyers from last year, close to 20% of them would not have qualified for their mortgage this year that they did qualify for last year. One of our agents who does a lot of relocation for military relocation, close to 15% of her relocating members would not have qualified for the mortgage in the new area that they were forced relocation that they were moving to, given today's economy.
Second question, after the rules were implemented, have you guys seen a decrease in the number of people applying for a mortgage year over year?
Not applying, but certainly qualifying. And if I could go back to your first question, first-time home buyers, at least in Atlantic Canada or in my neck of the woods, which is Halifax, most first-time home buyers are coming in with 5%. It's not, the problem with it is that it's a ripple up effect. So if that first-time home buyer can't qualify with 5% down, whose home are they buying who may have a 20% plus? If the person who has a 20% plus in equity on their current resident that is selling to that first-time home buyer, how do they then sell that house and move on if we don't have a first-time home buyer qualifying at 5% without a stress test? The stress test eliminates that first-time home buyer in a lot of cases.
Okay, my next question is this, is that, yeah, go ahead, Paul.
To the answer about the data, Canadian Real Estate Association will have tracking of all of the homes that changed hands this year, and if you were to cross-reference that against the records of insurance through CMHC and some of the private insurers, you actually should be able to figure out pretty quickly how many of those purchases were made with less than 20% down.
Yeah, no, I was just curious to see if you guys knew it right off the top of my head.
So, just so you know that in our industry, we're not able to collate all that data because it does go, it funnels through to the insurers, and that's where that data is held. We're just not going to be privy to that.
But you guys are also a part of the industry.
We're part of the industry, but we have to access the data.
My next question is actually extremely, how are you guys compensating the individual mortgage representative? So if I'm a mobile mortgage specialist in a city of Brampton, let's say, from my neck of the woods, how do you guys, what's the compensation model based on that?
First thing I want to point out is there's a big difference between a mortgage broker and a mobile mortgage specialist.
Okay,
a huge difference.
I know the difference.
So, well,
then
you should ask about the mortgage brokers respectfully, sir, because a mortgage.
With all due respect, sir, you didn't even bother listening to my question. My question was this: is that how do you guys compensate mobile mortgage specialists or people that their businesses is to go get clients who purchase homes and get their mortgages approved?
We don't compensate mortgage mobile specialists because we are not them and we don't utilize them.
Okay.
We are mortgage brokers. There is a difference, sir. You need to understand.
Okay,
that.
Thank you, Mr. Hamilton.
Sir?
Yes, go ahead.
I think there's a distinction necessarily between an individual who's an employee of a financial institution who recruits for one lender versus a broker who's independent, who is a commission-based agent who would represent multiple lenders for origination of a loan.
The theory behind the question is this. Yes, go ahead.
To answer your question about the percentage or proportion of those purchasers who use 20% or less down payment, we ran a survey last year, about a year ago, for all the Quebec market, and we have an estimate of something of 68% of all purchases would be with 20% or less of a down payment. That does not amount necessarily to use of mortgage insurance, but we're talking about those who answer the survey with how much down payment did you put there.
Thank you so much, George. So my question would be this, is that 68% that bought homes with less than 20% down payment, they were subject to a stress test before our rules were implemented. Is that correct?
That in those statistics here, to be more precise, relate to a past 5-year period. So I cannot speak to which rules were in effect at what time there. And you're right, stress tests and other rules were put there. But one of the most popular terms for mortgage, and our colleagues here will correct me, is the 5-year fixed term is one. 67% of the borrowers use a 5-year fixed mortgage. So that's the novelty here with relating to the last October announcement.
The very key distinction actually between the current and the previous is that the stress test only applied to people who are getting less than a 5-year term. Because the logic is, on a 5-year fixed mortgage, you have 5 years to accrue equity before you're actually exposed to the current interest rate again. In today's interest rate environment, even with a 5% down, you're almost at 20% by the end of that first 5-year term. The new changes, though, require everybody to suffer that stress test as a qualification mechanism.
We should define that stress test. I mean, stress test, the stress test for mortgages has always been there. That's the underwriting qualification criteria. It was maybe enhanced, but this idea that it's something new, it's not new. We've always had criteria for qualification. It was just actually made it a little bit more difficult or stringent. So these checks and balances have been in place for quite some time.
Raj, do you have one quick wrap-up question?
Yeah, just like what we heard from testimony is that the government is overreaching, that we're over-regulating, and that the impact is going to slow down the housing market. And it's going to have a negative impact on first-time buyers. Is there any actual research, or are you guys all of the opinion that it's too early to tell?
It is not too early to tell. Our association has a very large number of mortgage lenders and insurers actually as part of our constituent, and they will tell us specifically they've seen reductions in the number of applications for loans that they've funded and the number of insurance applications that they have provided cover for. There's some panelists actually arriving at the next session that will probably have much more personal data to be able to share with you on those questions.
Our numbers are down in the last 2 months, so I mean it's
Last year?
probably 30%.
30%.
Yeah. Drawing from the 2012 announcement to shorten the amortization period from 30 years to 25 years.
You're both okay.
20%, 21% housing start reduction in Quebec, 6% or 8% decrease in resale, and the impact of that shortening had the result of pricing out 39,000 households in Quebec who were not necessarily looking to buy, but had they wanted to buy, could not buy a house at average price then, given the change in the income requirement to purchase an average price rate.
Okay, just hang on. Has everyone answered your last question? Okay, quickly.
Saying that is the market slowing down? Well, yes, it's going to slow down, but it's going to also, it's a bit early to say, but it's going to slow down, obviously, the first-time buyers, the people who are on the fringes. But one compounding effect that we may see coming forward is that a first-time home buyer, what were they before? They were most likely a renter. And we have a limited rental pool in many centers. Now, the problem is that if you keep people in the rental pool and you can't get people to qualify as first-time buyers, you're going to have another stress test, in a sense, or a difficulty for people who want to rent. And those rents could possibly go up. So the overall cost is not just to the home purchaser, but to the actual person who's looking to rent. In Vancouver, the vacancy rate is very low. If we don't remove people from the rental pool and make them first-time buyers, then we have an issue of housing again on the rental side.
Okay, I'm going to stop you there, sir. We'll go to Mr. Dittel.
Thank you, Chair. Ladies, gentlemen, be welcome in your House of Commons. Very pleased to see you all. But I can say that I'm very proud of what we have heard a few minutes ago. It's totally unacceptable and unbelievable that this government took such a great, important decision without consulting any one of you. And you're not the first. We have heard some other witness before who said exactly the same thing. This is totally unacceptable, but at least, thanks to this committee, you can express yourself now.
I'm really interested, Mr. Taylor, if I could, if you could describe to me, because I'm new to the Finance Committee, so if you could describe to me, give me a bit of a profile of terms of the customers that come through your membership's doors. I'm just trying to figure out, do they carry more or less leverage than using more traditional means? I mean, do they have more of a, you know, if you use a loan-to-income metric or if your debt ratio metric, can you give me a bit of a description of a profile of your average customer, not your best, not your worst?
Okay, so thank you very much indeed for the question. This may take a moment or two, so I apologize, and if I get too long-winded, just we're an association of mortgage lenders, mortgage insurers, and mortgage brokers. The lenders within our community do actually include TD and Scotiabank. We also have First National, Street Capital, Merix Financial, and a whole raft of others. All that to say, We have some very large balance sheet lenders as part of our association, and we have some much smaller lenders that you would call more traditional mortgage finance company. The mortgage finance companies are much more reliant upon the insurance mechanisms currently available in the marketplace for capital adequacy and liquidity. The larger lenders have more access to their own balance sheet, and so they can hold the loans themselves.
I was just about to ask Mr. Soni if he would mind giving me a sense of his clientele on that front. Mr. Soni, please.
Similar question?
Similar question.
Well, what is our average type of client? Our average type of client is the average Canadian. We see a full spectrum of mortgage applicants. We see the first-time buyer, which is a large portion of a mortgage broker's business, but we also see the full spectrum to the point where we're doing development projects in the multi-millions, 30, 40, 50 million. We provide debt consolidations. We provide construction financing for small builders, average builders. The profile is the profile of a mortgage borrower. We see them all. We see high net worth individuals as well.
Perhaps compared to the banks, I mean, if I could just characterize it that way, would your clientele be more leveraged than the banker's clients? The average.
It's hard to say. I wouldn't say that they're more leveraged. There's certainly going to be some individuals based on our value proposition as mortgage brokers where we're going to deal with some people that could be placed into the higher category or risk area where we're using alternative sources of financing. But we have a lot of clients because, as Paul has said, a lot of our lenders are balance sheet lenders. A lot of our large monoline lenders like First National or an MCAP, they're looking for the quality borrower. We, as mortgage brokers, nobody faces as strong in a sense, stress test on the underwriting guidelines as a mortgage broker. Our files are scrutinized, they're audited, and they're good quality Canadian borrowers.
So you're saying then, or perhaps if I could understand this, and again, help me out here, if your profile is the same as the major banks in terms of whether or not your clients are financially stretched, then why is there such a difference in terms of an approach that from the testimony that we heard on Monday in terms of what the effect of these changes could have on the system? Mr. Taylor?
So I think I can get to the root of this. There are some lenders who will specifically focus or target on borrowers that have less appealing credit history. And so they might work in a marketplace where they will offer a higher standard mortgage interest rate because the risk of default for those clients is different. They're also generally privately funded, though, and so that is a separate category of lender, if you will, within our membership. There's not an awful lot of difference most of the time between the large balance sheet lenders' desired clientele and some of the smaller, I'll call them residential specialist lenders within our association. Each of the large and the small will use the securitization program to a degree. Each of them occasionally will be finding additional sources of capital, whether it's their own balance sheet or whether it's other mechanisms within the marketplace. The big difference between the two, and what will cause a reduction in competition in the marketplace, is that because the smaller lenders are more reliant upon the securitization mechanism, once that's removed, or the significant reduction of the risks that are eligible for that, makes the origination of mortgages for those folks almost impossible without having to find alternate sources of capital which are more expensive. Very, very simply here, when you bundle mortgages into an investment mechanism that's a bond, if it's insured, then the risk premium in the market is quite small. If it's uninsured, the investors require a higher risk premium, and of course the mortgage holder is ultimately paying for that through the interest rate that they're charged.
Okay, I have to stop you there, sir. So we'll take two more sets of questions of 5-minute-ish each. So we've got Mr. Albus, Ms. O'Connell, and then we'll conclude.
Thank you, Mr. Chair, and thank you again to all of our witnesses here today. I'm becoming very concerned because obviously GDP isn't where we'd like it. We're seeing a lot of the forecast downsides in many different respects. 13% obviously of GDP Canada is related to housing. So this is, I think it's important for Canadians to know when the government adopts a new policy or is looking to adopt new policies as well, that could have severe limitations or implications for them. So, for example, what from the previous October announcement and the implementation of the policy, things have been taken away. Options have been limited to Canadians. So let's start with amortization. Some might just say, well, shouldn't amortizations be at a maximum of 25 years? Mr. Lloyd, you work in Vancouver and the Metro Vancouver region. What do you have to say on 25-year amortizations, 30-year amortizations?
It sounds like a good idea, but the longer amortizations allow people to get into a home, keep that payment lower when they first move in, and then as they move along, they can increase their payments and pay it off faster. Just because it's a 30-year amortization doesn't mean it takes 30 years to pay that mortgage off. As soon as a client adjusts to biweekly accelerated, it knocks almost 4 years off of that right away. So to take away that mechanism, which doesn't it's a simple mechanism. It allows somebody to get into that house faster. I think it's just it doesn't make sense because it allows somebody to do that in a very simple way, and in the long run, it doesn't hurt anybody. They end up paying it off faster. Like I said, the majority of my clients never take that long to pay it off, and we encourage them to look for ways to pay extra payments on the mortgage and get it paid down sooner.
A lot of young people, the 30-year mortgage was a good option, but now that's just not there anymore.
It's gone.
Particularly, we're living longer, so obviously people are also choosing, in some cases, to work longer. They have longer lifespan cycle to be able to pay for these kinds of things. So to me, it would seem strange that we would be limiting that down and forcing some people to use up rental stock, which eventually raises prices in that area because supply isn't any better for rentals as it is for new construction. Now, you also mentioned a gentleman in the Kootenays who had a divorce. We're also seeing divorces are higher. And another thing that's been taken away is the ability to refinance. How have the changes impacted Canadians' ability to refinance their homes?
Canadians work hard to pay that mortgage down and to build up that equity. And these changes, what they've done is the vast majority of our lenders now can't do that because they're what we're talking about with bulk insuring and selling off their books. They're not allowed to insure a refinance. So client can't do anything except maybe go to a big bank who's going to probably charge them a higher rate to do that because it's going to be a smaller and smaller group of people that can do that for them. So it doesn't make any sense to me when a client, a lot of the times refinancing is what we use to invest back into the economy and build businesses and do good things, buy rental properties.
And that's a very good point because a lot of people, what they'll do is they'll build up that equity in their home, then take it out at some point, which now they may be denied, and either put it into starting a business or enhancing their business or perhaps creating new rental properties so that they can sell. So that they can have that extra money coming in. So what happens if someone wants today to buy a rental property, to be able to use that as another way to bring income for their family?
They have to have 20% down, and they have to go through a bank to get it.
Okay. So what was that previous to this policy being implemented?
Previous to that policy, we had access to all the non-bank lenders that had various policies. But
okay. So this is hurting the economy. It's hurting consumers because I hear from them in my riding, and particularly when I talk to people in Vancouver, it's just it's crazy. It's making it harder for people that to get good rental housing. Now, obviously, the competitiveness, and Mr. Taylor's really touched upon this as well. So I'm concerned that because of this, not only will it put many of the monoline lenders at risk, and by the way, that means less competitiveness. What does that mean for the market for Canadians in 10 years? We've heard from other people credit unions say that they have to risk to add a risk premium to things, and they can't do it because they are not allowed to retain earnings. So to me, that whole end of the market will shrink. Where will we be in 10 years as far as competitiveness and price?
Well, I can tell you, I started in 1994 as a loans officer at a credit union, and the most we could discount a 5-year rate was 0.25%. And that was for our absolute best client. Since brokers in the monoline industry have come along, we've grown that, and now a normal discount is 2% off of a 5-year rate. It could easily go back the other way when it's back to just the big banks.
Okay, sorry, Dan, that's 5 minutes is up. Jennifer, and then we'll conclude.
Thank you so much, Mr. Chair. Thank you all for coming. In terms of, I heard the conversation around good debt and bad debt, and I get it. However, isn't there the factor that whether you have an individual who perhaps has a mortgage that is a little bit more than they can afford if interest rates to go up, or a person who has a boat and a mortgage and can't pay both, that ultimately, if you can't afford your debt, whether it's good or bad, you stop paying for it and therefore causes problems within the economy. So this notion that, you know, if you have good debt, you know, that's all fine, and if you can't afford it, well, it's still considered good debt versus someone who can't afford their boat payments. So my question is, if, you know, there was concerns about, and my colleague just said that this hurts the economy, I'm wondering, what would hurt the economy and the housing market more? Would it be telling an individual that if interest rates were to go up, you could only afford this type of mortgage, or allowing them to have whatever mortgage they prefer without stress testing it to the realities of the economy and the situation right now, and homes and mortgages being defaulted? That is the option. You tell someone you can afford a little bit less, or they bite off more than they can chew in economic situations and mortgages default. How was that experience for the U.S. and people's biggest investment in their homes? Because when defaults happened on mortgages, so did value. So all that equity that was discussed was no longer there. Wouldn't that hurt the housing market dramatically if we didn't prepare and protect for risks like that? Sure.
Well, this idea of good debt and bad debt, when we lend somebody a mortgage, at that time, they follow the stress test. There's going to always, in other words, they qualify. There's always going to be an element of individuals that, and it's a small element, that will take their mortgage, everything's good, maybe they'll buy a boat after. Well, that's after we'd actually qualify them. That's going to be a small element, right? Your worry is that people take on too much debt. Well, let's look at the great success stories of all Canadians that have bought their first home. Think of your parents, think of your grandparents. There hasn't been an easy, I haven't heard one easy story about the first home people have bought. Sometimes they may feel a bit stressed, but are we to say that the average Canadian is irresponsible with debt? I don't think they are. I've been a mortgage broker since 1988, and I've seen nothing but success stories. Have we had some market slowdowns in that period? Yes, we've had. The vast majority of people continue to do what they have to do to make their mortgage payments. And today, when they first, say 25 years ago, when they were 25 years old, it was tough. Today, they've paid off that home. And they've been able to use that to fund their children's education.
Sir,
Sorry, I have limited time, so I'm going to interject, but I'm glad you actually brought that up, because the comparison between myself to my parents had double-digit interest rates. Double-digit. And so that comparison is exactly why we were doing this, to protect for changes in interest rates. So I want to just move on quickly because I have very limited time, but you spoke about municipal fees. This is my wheelhouse. I was a municipal councillor for nearly 10 years. And the suggestion to make development easier is actually the exact opposite that argument that you make in terms of regional differences. In my home province of Ontario, the province determines a lot of the supply in the area, and municipalities must comply with that first. So if you took supply issues and the federal government made a broad approach to that, you would have very different impacts across this country. So it's the exact argument that you are arguing against in the sense of regional differences. And wouldn't it be better to ensure that debt is debt, and that if people are at high risks, then then we ensure that there is protections in the market for when interest rates change.
I'm going to have to interject. I know there's a couple of hands up, so if you can answer Ms. O'Connell's question in about 20 or 30 seconds, there's maybe time for a couple of answers, and then we have to conclude.
First point I'd like to make is these changes are a little overreaching in how conservative they are in the amount of capital that needs to be reserved to ensure that the financial system doesn't fall apart, as you have alluded. Our default rates, actually not even, our arrears rates for mortgages are currently 0.28%. As we heard on Monday, they peaked in Canada at 0.65%, which is by no means anything close to what happened in the US. Interest rates dictate the stringency of the credit underwriting used to issue the product. Very, very simplistically. A credit card issued at 20 points can be issued with almost no underwriting. There's an expectation of default. That's what the market risk premium on that is for. At a 2.5% interest rate for a mortgage and the volumes that are being issued, believe me, the underwriting standards in Canada before those loans are issued are second to none in the world.
I have to stop it there. I'm sorry. Can you answer? Yeah, because we have to go to a vote. For those presenters who are here to present at 5:30, unfortunately, we have 2 votes in the House at 5:45. We cannot reconvene until closer to 6 p.m., so I apologize for that. But we will reconvene as soon as the votes are concluded, probably around 6 o'clock. For the presenters here at the table, thank you very much. We'll see you all back after the votes.